All right, let me ask you something, and I want you to really think about this for a second. Have you ever worked an entire month, showed up every single day, gave it everything you had, and then looked at your bank account on payday and felt like something was off? Like the numbers staring back at you just didn't match the effort you put in? Because I have, and I'd bet everything that you have too. Here's the thing nobody tells you. That feeling isn't just frustration. That feeling is a signal. It's your brain telling you that something about money, about how it actually works, was never properly explained to you. And that's not your fault. Schools teach you how to solve for X, how to write an essay, how to memorize dates from history, but they never sit you down and say, here's how the financial system works, here's how to build wealth, here's why your paycheck looks the way it does. And because of that gap, most people spend their entire lives working hard but never actually getting ahead. That ends today. In the next 18 minutes, I'm going to walk you through every core concept of personal finance that actually matters. Taxes, banks, interest, inflation, recessions, credit scores, the nature of money itself, investing, value, and time. Not textbook definitions, but real explanations with real examples. Before we get into it, hit that like button right now. It takes 1 second and it genuinely helps this channel reach more people. Let's start with the one topic that ruins everyone's mood on payday: taxes. Picture this. You just finished a brutal month. You put in the time, you did the work, and your employer sends over your pay stub. It says $2,000, but your bank account shows exactly $1,456. You scroll through the pay stub and there it is. Federal income tax, state income tax, Social Security, and Medicare. 4 separate deductions quietly slicing off pieces of your paycheck before it ever touches your hands. The gut reaction most people have is anger, but taxes are the price of civilization. That money funds the roads you drive on, public schools, food safety inspections, and the fire department. Yes, sometimes it funds things you'd rather it didn't, like billion-dollar defense contracts, which is fair to question. But the core infrastructure directly affects your daily life. Taxes come in many forms. The most familiar is income tax, which operates on a progressive system in the U.S. This means the more you make, the higher percentage you pay on each additional dollar through brackets. A lot of people mistakenly think earning more money means they lose wealth overall by jumping into a higher bracket. That's not true. You only pay the higher rate on the specific dollars that fall into that elevated bracket. Then there's sales tax, which hits you every time you spend money at a store. Buy a pair of sneakers for $100 in a state with 8% sales tax and you pay $108. It adds up fast across an entire year of spending. Capital gains tax is what you encounter when you start investing. When your stocks or real estate go up in value and you sell them for a profit, the government wants a cut. If you hold the asset for less than a year, you pay your normal active income tax rate. Hold it for more than a year and you qualify for a lower long-term capital gains rate, which is why wealthy investors hold assets for extended periods. Social Security tax automatically pulls 6.2% of every paycheck you earn, and your employer matches that exact amount. It is essentially forced retirement savings managed as a pooled system. Medicare tax works similarly, taking 1.45% of your paycheck to fund healthcare coverage for Americans 65 and older, which your employer also matches. Now comes the absurd reality of filing your taxes. The IRS already has most of your income information reported directly by your employer, your bank, and your brokerages. The IRS could theoretically just send you a bill or a refund, but instead the system requires you to file your own return and calculate what you owe. If you underpay, you face penalties. If you overpay, you get a refund, which means you gave the government an interest-free loan for the year. A tax refund isn't a bonus. It's your own money coming back to you late. The bottom line on taxes is clear. Learn the system. Understanding deductions, credits, and retirement accounts can legally reduce what you owe by thousands of dollars every single year. Now let's talk about banks, because the standard mental model is wrong. Most people think you hand over your cash, the bank puts it in a safe vault, and it sits there waiting for you. In reality, when you deposit $1,000, the bank is legally required to hold only a tiny fraction in reserve, which has been set to zero in the U.S. since 2020. The remaining $900 or more gets lent out immediately to finance someone's car, business, or credit card debt. This fractional reserve banking system runs entirely on the assumption that not everyone is going to ask for their money back at the exact same time. When confidence cracks, as it did in 2008, people pull money out simultaneously, and institutions face withdrawal, demands they physically cannot meet. In 2008, the system nearly collapsed until the government stepped in with the TARP program, injecting hundreds of billions to prevent disaster. Banks make money by paying you a low interest rate on your deposits, like 0.5%, and lending that exact same money out at 7% for mortgages or 20% on credit cards. The spread between what they pay you and what they charge borrowers is their profit. You provide the supply, borrowers provide the demand, and the bank acts as the middleman. We use them because of convenience, modest returns, and federal deposit insurance like the FDIC, which guarantees your deposits up to $250,000. Keeping cash in a shoebox at home means if it burns, it's gone forever, but a bank account protects it from physical reality. This brings us directly to interest, the concept that separates wealth builders from those who stay trapped. Simple interest is a flat, predictable percentage applied exclusively to the original amount borrowed. Borrow $1,000 at 10% simple interest for a year, and you owe $1,100. Compound interest is a completely different animal. With compound interest, you pay or earn interest on the interest that is already accumulated. Over long periods, the difference is staggering. For example, credit cards compound interest daily. If you carry a $1,000 balance at a 24% annual rate and make zero payments, you won't owe $1,240 under simple interest. You will owe closer to $1,271 because yesterday's interest gets added directly to your principal balance. Scale that up to thousands in debt over several years, and minimum payments barely cover the daily compounding charges, keeping you permanently trapped. But the magnificent flip side is that this exact geometric mathematics builds massive wealth when applied to investments. Imagine a 25-year-old putting $300 a month into an index fund averaging a 7% annual return. By age 65, they will have approximately $786,000. A 35-year-old doing the exact same thing for 30 years instead of 40 ends up with around $379,000. The younger investor made an extra $400,000 simply by giving compound interest 10 more years to work. To calculate this easily, use the rule of 72. Divide 72 by your annual interest rate to find exactly how many years it takes for your money to double. At 7%, it doubles every 10.3 years, but at 1% in a traditional bank, it takes 72 years. If you are paying interest, escape it fast. If you are earning it, leave it alone. If you leave your money sitting entirely still in cash, it faces a silent killer called inflation. You spend $150 at the grocery store today on the exact same items that cost $120 last year. The food didn't change, the currency just lost purchasing power. What cost $100 in the year 2000 requires roughly $180 today because the dollar got weaker. Inflation is driven by demand outpacing supply, cost-push factors like spikes in global oil prices, or expectations-driven psychology where businesses raise prices now to stay ahead of future costs. The Federal Reserve targets a 2% annual inflation rate to keep capital moving, but when it runs wildly out of control, their primary tool is raising the federal funds rate. This makes borrowing more expensive across the entire economy, cooling down consumer demand and slowing price increases, but it comes with the side effect of slower economic growth and potential unemployment. If your money earns 0.5% in a bank while inflation runs at 3%, you are mathematically losing 2.5% of your wealth every year, making active investing mandatory for financial survival. When central banks raise interest rates too aggressively to fight inflation, they often trigger a recession. Formally defined as 2 consecutive quarters of negative GDP growth, a recession means the entire economic output shrinks for 6 straight months. This triggers a devastating feedback loop. Corporations freeze hiring and execute layoffs. Worried consumers stop spending money on anything other than basic necessities, and declining retail revenues lead to even more corporate job cuts. Recessions are a natural, cyclical reset within a capitalist framework. The people who panic and sell all their investments at the absolute bottom lock in their financial ruin permanently, while disciplined wealth builders recognize downturns as temporary market resets that allow them to buy high-value assets at a massive psychological discount. To navigate these economic cycles smoothly, you must protect your credit score. Calculated by proprietary algorithms like FICO, this 3-digit number ranges from 300 to 850 and summarizes your creditworthiness for lenders. It dictates the exact interest rate you receive on mortgages, auto loans, or corporate credit. A premier score can save you tens of thousands of dollars over 30 years on the exact same house. Payment history is the most critical factor, comprising 35% of the total mathematical model, meaning a single late payment can instantly drop a great score. Credit utilization is the second largest factor at 30%, measuring your current balances relative to your total credit limits. Experts universally recommend keeping this ratio below 30%. Master the rules by automating your on-time payments, keeping balances low, and leaving your oldest accounts open to build long-term history. All of these intricate financial architectures rest upon the reality of what money actually is. Modern fiat money possesses zero intrinsic value. A $100 bill is just linen and cotton stamped with ink, costing 14 cents to physically manufacture. The only reason it can purchase real goods is a collective social agreement that it represents value. In this sense, government cash and digital Bitcoin are highly similar. Neither has physical utility, and both run entirely on mutual trust. The dollar functions because the government demands it for taxes, businesses accept it for transactions, and workers accept it as wages. The Federal Reserve manages this supply by creating money out of thin air to stimulate growth, or pulling it out of circulation to fight inflation. Printing endlessly leads to hyperinflation, which renders a currency worthless overnight, while a shrinking money supply causes deflation, prompting people to hoard cash and stalling the macroeconomy. Understanding money as a social construct shifts your focus away from paper cash and directly toward accumulating real, productive assets. This realization leads directly to long-term investing, which is the exact mechanism ordinary people use to build permanent financial security. There are four primary asset classes that dominate the global financial landscape: stocks, bonds, funds, and real estate. Stocks represent actual fractional ownership stakes in publicly traded corporations. If the business expands its profitability, your share becomes fundamentally more valuable. While the stock market experiences short-term volatility, historically the broad U.S. market has returned an average of roughly 10% per year before inflation over multi-decade horizons. Bonds are debt instruments where you act as the lender to a government or corporation that promises to pay you back with a fixed interest schedule, offering lower returns but providing critical stability. Funds, specifically low-cost index funds that track a massive market index like the S&P 500, are highly recommended because they provide instant diversification by design. Instead of risking capital trying to pick individual winning stocks, you buy a tiny piece of the entire market and benefit from its overall macroeconomic growth. Real estate is the final major asset class, offering long-term property appreciation and consistent rental income, though it requires significantly higher upfront capital and active management. The core principles of elite investing are straightforward. Start as early as humanly possible, diversify aggressively across asset classes, keep your fees low, and remain relentlessly consistent without ever panic selling during temporary market downturns. To fund these investments, you must understand the underlying laws of economic value, which determine how much money you command in the open marketplace. A random rock outside is worthless because it is abundant and possesses zero utility, but if those exact same atoms are arranged as a flawless diamond, people will happily pay thousands for it. The diamond is valuable because it is scarce, signal status, and decades of masterful marketing have tied it to the concept of romance. Value in a market economy is determined strictly by what a buyer is willing to pay, driven by perception, scarcity, and available alternatives. If you can master a skill or create a product that is highly desired by the market but incredibly rare, you can charge an immense premium. A specialized neurosurgeon earns exponentially more than a general contractor because their skill set is exceptionally scarce, while the human demand for life-saving surgery is infinitely high. Corporations like Apple do not merely sell smartphones. They sell elite industrial design, social status, and ecosystem lock-in, enabling them to command a massive premium far exceeding physical production costs. To build real wealth, stop focusing exclusively on working harder and start focusing on how to create, package, and deliver rare, high-demand value that the marketplace rewards disproportionately. Finally, let us talk about time, which is the single most important concept in this entire framework. Time is the only truly non-renewable resource you possess. You can always figure out a way to earn another dollar, but you can never manufacture more time. Every hour that passes is spent permanently, yet most people trade their time linearly, showing up to a job, selling an hour of life for fixed cash, and repeating until retirement. While regular employment pays immediate bills, it contains a hard mathematical ceiling because there are only 24 hours in a day. Individuals who achieve absolute financial freedom figure out how to completely decouple their income from their physical time by building scalable businesses or aggressively acquiring income-producing assets until their investment portfolio replaces their earned income. Nowhere does time wield more power than within long-term compound growth. A single $5,000 investment made by a 22-year-old left untouched will balloon into roughly $160,000 by age 67, while that exact same investment made by a 42-year-old grows to only $39,000 due to losing 20 years of compounding power. Time is the ultimate mathematical leverage that allows ordinary people with entirely ordinary incomes to achieve extraordinary, world-class financial security. You do not need a genius IQ or a massive inheritance. You simply need to start immediately, stay consistent through the highs and lows, and give compound interest the decades it requires to perform its miracles. The single most critical decision in that entire chain is always having the courage to start. Now you have covered more real-world financial education in this single video than most people receive across their entire lives. You understand that taxes fund society but must be optimized. Banks leverage your cash. Interest can either destroy or build you. Inflation requires an active investment defense. Recessions are buying opportunities. Credit is a game with clear rules. Money is a construct of trust. Value is driven by scarcity. And time is your greatest financial weapon. If this deep dive opened your eyes, drop a comment below and tell me exactly which concept hit your brain the hardest. If you know someone stuck on the hamster wheel who needs to hear this breakdown, share this video directly with them right now. Financial literacy is completely ignored by schools, which is precisely why this unspoken knowledge has to spread person to person. Hit that subscribe button, turn on the notification bell so you never miss an episode, and I will see you in the next video.